Understanding what liquidity is in trading is the secret to making money from the markets. Liquidity is an area where buying or selling has previously occurred, which is likely to have generated lots of stop losses. Liquidity equals the place where lots of people have put their stop loss. Liquidity is the area where lots of people are going to lose their money. It often means that swing highs and swing lows are areas where lots of liquidity is being generated because people are putting their stop losses behind them to make their trades around. If you consider the classic support and resistance, those are actually areas of massive liquidity. Retail traders who are learning to trade support and resistance are actually being tricked by big money into placing their stop losses in the same area so that they can be swept and the big guys take their money. Areas of equal highs and equal lows are also places to look. This is particularly true when you get a series of equal highs or lows, as more and more stop losses are being added to positions every time price visits the area. When we see these equal highs in this area, for example, this area would be quote unquote resistance. What actually happens is price prefers to magnet towards this and blast through. If we scroll up the charts, we can see here it's a trend line. Trend lines are also used to generate lots of liquidity, as retail traders are addicted to buying and selling straight lines. What about chart patterns? Well, let's follow this chart a little bit further. This is a triangle, which is known as a descending triangle, should have sent the price downwards, but instead this is just another tool for generating liquidity. In this area, we can see that the market makers are creating a series of equal lows in this area that most people start to think of as a support. They start taking long positions on the grounds that this might go up. At the same time, other people in this area are starting to see this trend line develop that's coming down and developing a triangle pattern. So some of these guys might be foolish enough to start going short. And then there is this fake out, which means that everybody that's starting to go short gets wiped out. The people that have been going long start adding to their positions, or people come in fresh to the market because they believe this is the breakout from a triangle. But then what happens? They all lose. And in the end, price comes back and sweeps all of the equal lows and creates a trap. So the market makers are fooling people in both directions by using this triangle pattern, when in fact, the only thing that matters is where is the liquidity. The market makers will move price to liquidity before taking it to the next level. So if you can start identifying liquidity on the charts, then two great things are going to happen. You will stop losing. You'll be able to get amazing entries and start making some big boy bucks. Just like we can see on the chart here, if you can learn to enter in these sorts of positions, you can get an amazing risk reward. And check out my other videos if you want to learn more about risk reward. The bottom line is that the entire market is rigged around the need for market makers to create and then take liquidity. Anything else you learn about trading that does not have this at the center is probably nonsense that is going to lose you money. Liquidity is the grease in the engine. It is the handcuffs on the genie in the market. It is the unspoken rule that everybody needs to learn if they want to succeed in trading. Check the links in the comments and the description to get a free training course which will teach you how to actually beat the market using market cycles and liquidity. And don't forget, like, subscribe, and check out the channel for more information. I'll see you again.